Hi, Bill Lethman here from Lethman Financial. In this video, I'm going to talk about the Stretch IRA and how you can maximize the tax-deferred advantage of your retirement accounts. When it comes to maximizing the tax-deferred advantage of your retirement accounts, there are basically four strategies. Number one, you can delay the payment to the IRS as long as possible. This is probably the most common strategy. The longer you delay paying taxes to the IRS, the longer you get to use their money and earn a return from it, so the better off you'll be. However, as you probably know, you can't delay forever. In the year you turn 70 and a half, you need to begin taking required minimum distributions. RMDs, as they're commonly called, don't require you to take out all of your money, just a minimum amount each year. The second strategy is to take the money out at a bargain rate. On your company-sponsored retirement accounts, like a 401k, you may qualify to take your money out at a reduced rate. The first is net unrealized appreciation, NUA stock. If you have highly appreciated company stock inside your 401k, you may be able to take out some or all of your stock and only pay ordinary income taxes on the original cost basis at the time of your distribution. So you're essentially moving your company stock out of your 401k into a non-retirement account and only paying taxes on your cost basis. Here's how it works. Let's say you work for ABC Incorporated and you have $100,000 worth of ABC stock inside your 401k. Your cost basis, the amount you paid for the stock, is $20,000. You can transfer your ABC stock worth $100,000 to a non-retirement account and only pay taxes on $20,000. You'll be taxed at your ordinary income tax rate on your $20,000 cost basis. However, your $80,000 gain will only get taxed when you sell the stock. And not only do you get to defer the gain, but when you do decide to sell the stock, you'll qualify for the long-term capital gains tax rate. Currently, long-term capital gains get taxed at a rate of 15% compared to a top ordinary tax rate of 35%. So taking advantage of net unrealized appreciation can potentially save you a bundle in taxes. One more thing on NUA. If you still hold your NUA stock when you die, your beneficiaries will only get a stepped-up cost basis on the growth from the time you pull the stock out of your 401k. So in our example, let's say that your NUA stock was worth $150,000 at the time of your death. Your beneficiaries would have to pay long-term capital gains tax on the $80,000 net unrealized appreciation from the time you took it out of your 401k. However, the $50,000 of growth that occurred after you removed it from your 401k would qualify for a stepped-up cost basis, and no taxes would be due on that gain. I know this gets a little complicated. Before you initiate an NUA stock transfer, talk with a tax or financial professional who is familiar with how this works. The next bargain rate strategy is the 10-year averaging rule. I'm not going to spend a lot of time on this because it's becoming less common. If you qualify, you can pay the tax on your distribution as if you were taking the entire amount out over a 10-year time period instead of all at once. This could significantly lower your tax liability. However, to qualify, you must have been born before 1936. The third strategy is to pay the tax off early. If you don't plan on spending some or all of your retirement assets for at least 10 years or plan to leave your accounts to your kids or grandkids, then converting to a Roth IRA may make sense. By converting to a Roth IRA, you pay your taxes now so that you never have to pay taxes ever again on that money. And finally, the Stretch IRA. The Stretch IRA is essentially a way that your IRA can continue to defer taxes for your kids or even your grandkids. Unless you're planning on spending on all your retirement assets before you die, you'll want to make sure that you take advantage of this. A Stretch IRA is any IRA set up so that it can continue its tax deferral for your non-spouse beneficiaries. To do this, you need to make sure your IRA follows these three simple rules. Number one, the most important thing to do is to name a beneficiary. This may sound simple, but you may be surprised at how many people mess this up. Check your beneficiary designations on all your retirement accounts, then get a copy of your beneficiary designation page and keep it in a safe place with all of your other important financial documents. Number two, don't name your estate as beneficiary of any of your retirement accounts. This is bad. Naming your estate is the equivalent of having no designated beneficiary, which means no stretch. And finally, if you want to name your trust as beneficiary of your retirement accounts, it must meet 5 criteria for the IRS to look through the trust and to use the beneficiary's life expectancies. Check with your estate planning attorney on this. That's it for this video. I hope you got some great information. If you want to get more tips and strategies like this, click on the link below to check out my free retirement guide, How to Retire Happy, 7 Simple Steps to Creating Your Ideal Retirement. Thanks, and I'll see you in my next video.